you often hear of big, scary words, particularly, I reckon, around election campaigns. It could be like clickbaity stuff online. It could be a variety of things. And it's around this death tax. Oh my gosh, there's a death tax. Well, we're going to unpack that exactly because I think it's overinflated
sounds
online.
scary.
Sounds scary. We'll talk about inheritances and all that stuff. But, yeah, we just want to kind of take the hype out of when you hear big statements like death tax and inheritance tax and all this stuff because the long and the short, there is no death tax or inheritance tax in Australia. But we'll talk about where these words could come from. Martin McGrath, thank you for joining us again on Retire Right.
Thank you, Glenn. Great to be here as always.
You ready to do a potty?
Let's discuss.
All right. Actually, I'd tell you a weird story. When I go to America for podcast conferences, because we shorten everything, I was like, oh, so yeah, do you do a potty or whatever? And this lady's like, what, potty?
Like
toilet?
A toilet train or something, yeah.
So anyway, are you ready to do a podcast? Yeah. Let's get it on.
This is a podcast that will help you plan and execute one of the biggest moments in your life. That's retirement. You'll learn how to set up your finances in a way that benefits you, your lifestyle goals, and keeps you in the know within this complex world of money and investing. Your host is Glen James, former financial advisor, author, and host of the popular Money, Money, Money podcast. Glen is joined by experts in various fields around the topic of retirement in Australia. Any advice in this podcast is of a general nature. Full details are in the show notes of this episode. You only retire once, so make sure you retire right.
Okay, Marcus, thanks for writing in with your question. What do we do with inheritance? We'll get to that because that's a big question. But the next thing is, do we pay a death tax? And then ways to make this less stressful at a stressful time. So some great fodder there within such a very short question.
Yeah.
So I said at the intro, there is no death tax in Australia. There is no inheritance tax in Australia. Why are we seeing this stuff online? Nashi, what up? Like, what is it? Because I think it's worth unpacking.
Yeah, so exactly that. Is it automatic? Your day you die, all these taxes are paid? No, there's not. But when wealth is transferred between humans, whether you're alive or not, there can be tax consequences. So there you can definitely spin this into death taxes. So there's a few different parts of, if I inherit the house that someone lives in, do I pay tax? Generally not. If I inherit an investment property or some shares, do I pay tax? Well, the day it gets transferred, perhaps not. But if you then sell that, maybe. So there's taxes in some of those personal assets.
But it's the flow. It's like there was no tax on the inheritance.
The actual transfer or the death itself.
But once it got into your name, if it grew overnight, well, yeah.
There could be some tax.
Yeah, or income from that asset.
And if that person sold it when they were alive, they were paying tax anyway. So it's not extra tax because of death. It's tax because of exactly the flow of assets. So there's those parts. Cash being transferred, no, well, generally no. There's not a tax on cash being transferred or part of an estate unless the cash has come from an asset being sold. Super is generally where this kind of headline comes from. So is there a death tax on super? No. However, can there be taxes when money gets paid out of super depending on who the person receiving that is? Yes.
Okay.
There's a big ramble of words.
Yeah. But I think what we probably need to do first is step back. And I lost my train of thought. Hang on. Just pause for 1 sec. I'm back. Before we go any further, it's probably really important to build a foundational understanding of the two types of what they call SIS, Superannuation Industry Supervision Act. Is that what it stands for?
Good. Yeah.
Yeah, that'll do. Are you sure, Martin?
I'm not sure.
No, it is.
That's how nerdy we are.
I literally was just Googling and fact-checking myself. Yeah. So the Superannuation Industry Supervision Act, 1993, We call it the CIS Act.
One of my favourites.
You love it.
Yeah.
Clearly, you remembered the acronym and all that. So when it comes to superannuation, there are two types of dependents. And this is where it can get confusing fast. I remember when I was studying financial advice, I'm like, well, this is confusing. We've got a CIS dependent. Straight up, you can be eligible to receive money from superannuation. So there's a CIS dependent. There is then a tax dependent.
And they can be the same, but they don't have to be the same. They can also be different.
An example is a child or a child under 18 or a spouse is a CIS dependent and a tax dependent.
They tick both boxes.
Yeah.
Yep.
So dad dies, mum can inherit his super, no tax.
Correct.
Dad dies, there's no kid, there's no mum, the kids are under 18, they can inherit dad's super, no tax, because they're a CIS dependent and a tax dependent. What if I'm a child, an adult child over 18? I'm still a CIS dependent, but I'm not a tax dependent. And this is where things can unravel.
Yeah, correct. And when again,
But also not heaps, but kind of can.
And not with planning. And so without getting too stuck in the mud, we're talking about some components there. There are actually some untaxed components that there are exceptions to that, but let's move on from that because that's pretty rare. And also even that an adult child can actually still be a tax dependent if perhaps they are actually relying upon that. There's an independency relationship or
Could be
something like that.
like they're relying on you for financial assistance. Could be a disability.
Could be a 40-year-old still living at home or exactly needing assistance from mum or dad, even though they are over 18, they still could be.
For the legal kids out there, look at some case studies on that when it goes to court. I don't remember the top of my head, but there was anyway.
So
it's wild.
There are exceptions to every rule, but we're generally saying if you're over 18, over 25, you're independent, living on your own, you can still be a CIS dependent, and i.e. receive money out of mum or dad's super if they pass, but that normally would mean you're not a tax dependent on those proceeds.
Yeah. One step further to build on our understanding of this conversation, let's just assume we've got a super fund and there's $500,000 in it. And from day one, every bit of money has gone into that super fund as an employer contribution. Not any personal contributions, not any rollovers from an old defined benefit, not some legacy product with 15 different components. Because within super in the background that you will not see these on your statements, everyone. I've not seen super statements that have the tax component breakdown.
If they are, they're on page 7 or somewhere. You're not getting that far to look at that detail.
So most people in the background of their super fund will likely have two tax components. Tax and tax-free.
Yes.
The taxed portion is all the money that's gone in from your employer, because the government has taken their 15% or 30%, depending on your income, and then that goes into that corner.
Yep. And to add to that, all of the earnings while you're in accumulation phase. The dividends and the growth, they sit in that taxed column also.
Yeah. So back to this, and I think what we'll do, we'll use an example with the adult children and the dependents and the estate, and we'll just assume that the $500,000 is all taxed. So $500,000 all taxed, whether it goes to a husband, a wife, a financial dependent or interdependency relationship, or a child under 18, that $500,000 straight to them tax-free.
Correct. Agreed. And I think just interjecting as well is that if I'm the 70-year-old who's retired, does this tax component affect me? The short answer is no. If you're in pension phase, whether it's taxable or tax-free, what you receive every week or fortnightly or month, or if you take 50 grand out to buy a car, that's all tax-free for you. So kind of we get a bit further confusing here, but while you're alive, it's tax-free. We're talking about this is important upon your passing.
Yeah. So, curveball, I'm 60, 65. I've got access to all my super tax-free. I'm 65. I've got $500,000 in my super. It's all in the taxed component. I die and I've got a 20-year-old child who's the sole beneficiary. What happens?
They're independent. They're moved out of home.
They're moved out of home.
They're living their own life.
They're now assist dependent, but they're not tax dependent.
Okay.
So they're, living their life down the road, no financial dependency.
And you've retired, you've enjoyed retirement, but
You're
unfortunately
65.
you didn't enjoy life very long,
No.
unfortunately. And so, does that super get lost? No, it's your asset, so it gets passed on to your beneficiary. With your super fund, you should have a beneficiary on file. They can be what's called lapsing or non-lapsing, or you might not have a beneficiary.
Or binding or non-binding.
Right, exactly. So there's very different types. We won't get too, but let's assume that you've nominated your 20-year-old to be your binding beneficiary.
Yeah.
You can either do that, again, directly to them, or you can say, send it to my estate, send it to my legal personal representative, and send it so it follows the instructions of my will.
And just on that, your superannuation does not form part of your estate.
By default?
It's not an asset of your will.
Unless you intend to send it there directly,
Yeah.
which you can do, but otherwise, we're saying in this case, you're sending it directly to this 20-year-old individual. Do they have to pay tax on the case study we're talking about today? Yes.
Okay. 65-year-old dies, 500K in super, all taxed component. Child who's 20, independent, going down, working, all that. Knock on the door, hey, your dad died, if you didn't know, all that. He's super, you're the binding beneficiary, direct to you. How much tax does that person pay on that 500K?
They will pay 17%.
Right.
It is a flat amount. It doesn't matter whether you're unemployed. It doesn't matter if you're working and earning $100,000 or it's not. Other income in or tax in your life is a scaled system. This is a flat rate of tax. It's 17%. That doesn't sound really high, but 17% is...
$85,000.
I agree. So
You're good, aren't you?
yeah, well, one of us had a calculator. We'll figure out who that was, but that's okay. But no, so $85,000 is a large amount of money. The government goes, well, you get to keep the other 83%, but we would like to take 17% of that.
So where did you get the 17% from?
So how does that tax work? On the taxable portion, 15% is taxable. Then, if it's received personally, you need to pay the 2% Medicare levy.
Yep.
That applies. So that's 15.
So it just
plus
falls
2
on your
gets it.
ITR, on your tax return.
Correct. Yeah. So now, most super funds will take that tax out before you receive the payment. It's just to go in your tax return, and sometimes it can affect other thresholds or rebates or whatever.
Your family tax benefit,
Sometimes HEX repayments,
HEX,
private health insurance rebates, etc.
Yep.
So it can have a flow-on effect, but the direct tax usually happens that way. So you get the $415,000, tax is taken out, you've still got to declare it in your tax return. I think all funds now have to, but in theory otherwise, if they didn't take it out, or if you got an SMSF and someone didn't take it out, if that was the case, you might get the $500,000. Then when you get your tax return back, there's a big bill there to pay. So most of them deduct the tax before you receive it.
Now, if I'm 65, I've got my $500,000, taxed component, I die, in my super, I've got a binding beneficiary is my estate, legal representative, my will. That $500,000 goes into the estate of the late Glen James. Oh, my 20-year-old child,
He's the sole beneficiary
he's the
of
sole
it.
beneficiary of the estate. How much tax does he or she pay if that super goes through the estate?
So does tax still apply? Yes. Some people think you can avoid it that way. No, you can't. Tax still applies. You still have to pay that first 15% we spoke about, but you avoid the 2% Medicare levy
So that's $75,000.
instead of $85,000.
So the question is, with some careful estate planning, can you reduce the tax burden to your beneficiaries and estate? And the answer is yes.
Yep.
Can you remove it? Sometimes, and we'll get into that. But the question basically goes back to, in theory, no, there's not an inheritance tax in Australia. Sounds good to say there's a super inheritance tax. There's a
Big scary headlines. Yep.
If I want to take this one step further, if I had $500,000 in the super, same situation, 250 of that I put in as personal contribution.
Sold a house before
Sold a
you
house,
retired,
250. The other 250 came in through my employer. So half the situation in the super is taxed, the other is tax-free. If I die and my 20-year-old son or daughter, same situation, gets that 500 directly, they're not paying the 17% tax on the full 500, only on the amount that has been put into super via SG work contributions that's been taxed at 15%.
Correct. Agreed.
So the portion that they get of that 250, that the tax has been paid because I paid tax on my income, put it in my bank account, then put it into super. It got flagged on the way into super.
Goes into a separate column.
And then it's just a rinse and repeat. If it then went through my estate, I'm paying 15% on the 250, not on the 500 and not 17%.
Yeah. So hint to that is the more you've got in that tax-free column, the less tax your beneficiaries would pay.
Yeah. So pausing there, we'll have a break and then we're going to come back and talk about, Michelle asked the question, how do I maximise recontributions? Because this is where a recontribution strategy can walk in the door. We'll be right back after this.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to retireright.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia so they can connect with you wherever you are. That's retireright.com.au and click Get Help.
Okay, we are back. So, Marcus, I think we'll come back and do another episode on what to do with inheritance because I just want to focus on this death tax question that you had and the super tax. Now, Michelle asked, how do I maximise recontributions and what are some potential errors? So, I'm now going to shut my foul mouth right up because you live in this world every day. Again, I know enough to be dangerous. How can one of these recontribution strategies help the overall tax position of the estate?
Yeah, so what Michelle's saying there is following that question from Marcus of, okay, that sounds like a problem. How do we avoid that problem? Is there a way we can be proactive with that? And there is. It's what's called a recontribution strategy. Back to that example, you said that 500,000 and 250 from work, 250 voluntarily. So can you within super just move from one column to the other? No, you can't. But if you do a process of transactions or a few different bank transfers, you actually can. And so what that looks like is you're 65, you retired. Can you access your super at that age? Yes. You're alive, so any money you take out over the age of 60 is tax-free to you. So if I take out, and I might just use an easier figure today, call it $300,000. If I take $300,000 out of my super fund, I'm taking that out tax-free. The day I do that, I'm not paying any tax. And it comes out to me tax-free. It comes from my super fund to my personal bank account. If I then decide the next day, you go, you know what, that's probably better actually in my super fund, I'm going to redeposit that into my super fund. And I'll talk about certain limits and rules and some errors to make. But if you redeposit that back into your super fund, when that comes into the super fund, it's coming in as new money. And they're saying, well, where did this money come from? Oh, it came from my money in the bank. It's only been there for a day, but it's from the bank. Okay, that's actually a tax-free contribution. We'll put that in your tax-free column. So effectively there, you're moving it from the taxable column to the tax-free column. Not within the fund, you can't just fill out a form, but a bank transfer out to yourself, a bank transfer back into the super fund.
So it has
moves
to be
from one.
physically, it can't be a line item at the super fund,
It can't be
a
exactly
paper entry or whatever.
Yeah, it can't be a paper entry or a journal entry, or accounting entry. It has to be a physical movement of cash, and that moves it from one way to the other, and it moves it across permanently. It doesn't you don't have to do it again later, but there are certain limits on how much you could or should take out, and there's definitely limits on how much you can put back in.
Looking back, because I must say, I just love talking on this podcast. Like, I love hosting this podcast more than I love hosting Money. And it's multiple times smaller than the main show. But because there's so much intellectual juice with these strategies.
And they're so jumping in that, they're tangible. That's why we specialise in retirement, is that we can take action with people today and fix things next week or next month, and it's tangible. So it's powerful.
And this is where I think the value of advice is so amazing. And tell me if I've remembered correctly or if it sounds so crazy. Like, I think I remember doing a strategy with a client, and he was older, she was younger. They were retiring. I think we pulled a heap of money out of his super because he met the full release, almost put the full 300 or whatever the NCC cap was at the time back into his super, the rest put into hers because she was a few years out from age pension, preservation age and all that. So we kind of killed two birds with one stone. I think I remember we did his super pension account was 100% tax-free.
Yep.
So if he died and she died prematurely, that portion of his money when he died would go to his kids tax-free. But the other advantage of ripping it out of his, stacking her deck, we've got more money into her super environment.
She's younger.
Because she's younger. And then also all playing at home, the reason why we do this with Centrelink.
Because that asset, if you're below 67, you're not eligible. That is hidden from the Centrelink asset test if it's in accumulation.
Yeah. So there are so many, and this is why getting advice 5 years leading up to your quote-unquote retirement idea is really valuable.
It is, and we'll come back to the question, but while you started at the tangent, I've got a client I'm catching up next week. I've looked after
I'm good at
5
tangents,
years.
aren't I?
We're both in the same camp there. And they have, without revealing all the information, they have over $1.4 million in super. He is getting a full government age pension of $26,000 a year, even though to be eligible for a full pension, their assets have got to be below $400,000. So something's not right there, Martin. How does that work? We were proactive. They came to us. We worked together for a while, and we were moving money across for about 4 years in a row to load money into her super out of his super. So yes, their super's worth $1.4 million. His is worth about $300,000, and hers is 1.1.
It's hidden from Centrelink at the moment.
Centrelink don't care about her 1.1, so they're getting a full pension. I had a listener from the podcast speak with me earlier this year, and they're there. My partner's 68, I'm 65. Could we be hiding money to get it across? Potentially, but because of your wealth, you needed to start this 3 or 4 years ago. So there wasn't enough time to actually get enough out of his name into her name by the time she turned 67. So these strategies are valuable. They are tangible. The first client I mentioned, there's a 2.5 year gap. So that's $26,000 for 2.5 years. There's $70,000 of age pension there.
But isn't financial advice too expensive? It doesn't pay for itself.
No. Free rego, council rates discount, all that kind of stuff. Yeah, I think they're pretty happy. I'm pretty confident they've got value for what they're paying, let alone the investment markets, the rest of it. So, yes, value in strategies, but also importantly is if you want to retire tomorrow, don't ask what you need to do today. We do need to start this a few years out. So segueing back to this recontribution strategy, so you can see there moving some money in and out of super can reduce this. Now, these limits and rules do change, but as they stand today, you can take as much out of super as you want, but you can only put back in $120,000 as a voluntary contribution per year. If you want to, you're allowed to do what's called a bring forward and use 3 years at once. So you can put 360,000 in today, and then you can't put any more in for 2 more years' time because you've used it the next few years. So what that would allow someone to do, if they had a balance of 360,000 that was all taxable, you take the 360 out, you put it back in, you've turned that tax bill that your dependents might pay from $60,000 or $70,000 to zero.
A couple of things before everyone goes and just allocates their super to their estate to save 2% tax if there's adult children involved and whatnot. I think I just want to caution that as part of your broader estate planning considerations in concert with your lawyer and solicitor, there could be a good reason with the estate plan to pay the 2% premium to make sure the money goes direct to an adult child.
Yeah.
So that's just there could be blended family, and because one thing I know, if there was going to be something to challenge, the low hanging fruit would be easy to challenge the estate than challenging a binding beneficiary. 100%.
Yeah. And I think, again, we'll come back to, Michelle, the mistakes we see. It goes in that broader planning. It's not just about the tax, it's broader planning. But also on that point, and again, stay on the line we're on, if I'm 65, I can solve that problem, I might as well do so. But because of those limits, if I've got $1 million in there, I probably can't do so. If I'm already 76 and I can no longer put it back in, what do I do? And so I suppose that's some future planning of, do you leave it to your partner or a dependent? Well, at least that's going to avoid the tax. I had a conversation a couple of weeks ago with some clients we look after who are in their 80s and they have a very large taxable portion on a very large super balance. And they're very switched on, and we're transparent and explain, well, we can't do this recontribution strategy because you're too old to put it back in. And we came to the agreement, well, at the moment, we're both alive. So if something happened to one of us, it goes to the other tax-free. When one of us passes away, that's when we would need to up the ante. Now, again, can we do a recontribution strategy? No. So how do we solve for that? Is that you forward plan, a future plan, you keep it in there for as long as possible, but not for too long. Because if I know I'm going to pass away in a month, which you don't always know, but if I take that out while I'm alive, that saves the tax. Now, you don't always know that, unfortunately, but...
It's the old joke of the defined benefit pension when you're on the deathbed in the hospital, get someone to move your hand and sign that cash out bit of paper in action today.
And so we joke about that, but I remember going to a conference a few years ago and they basically said that people over the age of 70... with about 60% confidence do know when they've got 12 months or less to live. That there's often a health event, a diagnosis, people see the decline, and or family might see the decline. So if you're listening to this as a 55-year-old and mum and dad are in their 70s or 80s, knowing this, I'm not saying an 80-year-old should go and pull their money out of super today. We're not giving that advice. But when we talk to our clients, when we ask them about their health, when we talk to their kids, we ask them about the health so that they know, hey, every year that dad keeps this in his pension, he's saving a lot of tax because it's tax-free. He's saving $50,000 a year by not pulling it out. But if it's still in there when he passes away, we might pay $300,000. All right, we need to make a decision at some point. So we often do that if people move into aged care or something like that. I've got a client, we did that again earlier this year. She's 87. She's moved into aged care. She had a substantial balance in super, about $2 million.
Did the power of attorney execute that?
Yep.
Yeah.
About $2 million in pension phase. More than half of that was taxable, so we're looking at a $200,000 tax bill. Now, if she pulls that out and we put that into another investment product, in this case an investment bond, in different situations there's different products you would use, we've eliminated that $200,000 tax. She's going to pay more tax on that investment bond than if she kept it in pension phase, but that equates to probably $20,000 or $30,000 a year in tax versus saving $300,000. And so I suppose we're just making that assumption that she's not going to live for another 8 or 9 years, but at least that tax is sorted.
Yeah.
So there is recontribution strategy does solve it, but also planning and being proactive.
Yeah, if you get a terminal diagnosis and you don't have a spouse or partner and you've got adult kids and you do have significant wealth in your super, there is that argument. It's like, okay, do we, line the ducks up, make sure we're a power of attorney in because it's not all about the money,
execute.
but if we can do some practical things to not pay $300,000 in tax, I'll do it.
Then we do, yeah.
So I think it is just that.
And the other preceded caution there is what we're talking about is if you've decided, my pension will go to this beneficiary, but my will will go to that beneficiary. If you pull that out of pension fund a month before you die, beneficiary B, that's going to be in your will. Versus beneficiary A might go, okay, I'll get your pension, that's worth $2 million. They can have the house worth $2 million. So the will says pay all of my personal assets to beneficiary B.
Yeah, you could cock it up.
I'll put the cash in the bank to save the tax. Beneficiary A is getting nothing because there's nothing left in the pension fund.
And that's why I would imagine you looked at the investment bond because it
that gives certainty of the beneficiary. It sits outside the estate again.
Yep.
So there are some practical planning things there to do leading up to retirement, in retirement, and post-retirement.
But remember, to the skeptics, financial advice is unaffordable and there's no value. I know you hate me, everyone. It's okay. I'm just joking with you. I actually, in finishing, Martin, I just want to deviate from the other questions because this really does tack in. Someone in the Facebook group wrote, I won't say their name, "Hi, I wrote a letter to Australian Super for my contribution as a downsizer. It's not approved because they said I submitted the downsizer contribution form and I declared that the information is true and correct. My question is, what will happen to the money I put in and what impact will it have on my taxation? Would I be able to claim it as a tax deduction? What is the best thing to do to reduce tax with an investment property? By the way, the downsizer I contributed is from the sale of my property, which I explained that I made a mistake on submitting the form." So that's an issue. And this is the problem and the danger with Facebook groups, this podcast and all that. We are throwing out bits of information in silos. A little bit of lost in translation can royally F you right up. So that's right. It's really hard to bring awareness to people listening in Facebook group. We can give you the puzzle pieces, but if you get it wrong,
how to put them together.
It's sometimes irreversible tax damage and all that. Interesting comment here. Someone said, going back through your previous posts, you asked if you could use a downsizer from an investment property in November. So this was in April, and multiple people said no. You have then submitted the paperwork and ticked that it was a legitimate downsizer payment. Don't want to sound harsh, but you didn't even take the free advice that was offered. Hope you can, in Glen's word, unscramble this egg. So he said in another post, it is sitting in downsizer contribution and I'm trying to refund it, but they rejected my request. So if I can't put it in as a downsizer, why won't they refund it to me as I'm allowed to put investment property sale, as I'm not allowed to put investment property sale to downsizer? I'm confused. They're probably just seeing it as a non-concessional contribution.
Yeah.
Sorry, you put a non-concessional contribution in and you may have used some bring forward. Good luck unscrambling that.
Yeah.
You probably won't.
And or by the time it is unscrambled, because some of this reconciliation from the trustees or from the ATO when they data match happens after the end of the financial year. So it may be 3, 6, 9 months later you get a determination saying you've done this, you shouldn't have, here's the money back, or we're going to reallocate it. That may not happen at all, but it may happen after. And you go, can I reallocate it as a... No, that's gone. That went past 10 months ago. You can't re-put those funds back in.
It's not a self-managed super fund, my friends.
We can't backdate certain things. So, and it's probably connecting that a little to Michelle, which we've touched on a little bit, but what mistakes do we see? Some of that, people taking out too much and not be able to get it back in. Putting in $1 too much. So that limit, as mentioned, is $120,000 a year. If accidentally you put in $121,000, then what you've actually done is you've triggered the bring forward, whether you wanted to or not. So that means that for the next couple of years, you can only put $239,000 in. You can't do an extra $360 the year after. There's also a market timing risk of this, that while we've made it sound simple, there is paperwork and forms to do in that, okay, that's a withdrawal form, that's going to take a week to process the new application to go back in. Am I going back into accumulation phase? Am I going to pension phase? If I put it back in the pot that it's come from, you can mix it together. You can mix components. So back to the 500,000 example, if you take 360 out, put it back in, you're then going to end up with, 80% tax-free. If you want to do it again a couple of years later, you can't pick the components you're withdrawing out. Any withdrawal has to come out pro rata. So sometimes we do separate the funds, and this is your tax-free fund, that's your taxable fund.
You took the words out of my mouth. So for broader estate planning, and, again, I'll sound like a broken record, but the value of advice is, we'll do a recon strategy and we'll put the adult children on this fund that's all tax-free. Oh, you've got new kids from a new marriage or whatever that are under 18.
Or a spouse or a new spouse.
Or a spouse, like that, we'll keep their assets in this super fund that holds all the taxable components. And that's like, so a self-managed super fund, you do have the flexibility to, when you make withdrawals or whatever, to just flag what component it's coming from. But with retail world and industry super fund world, it's...
Yeah, so technically no with a super fund, practically yes. So the difference between a self-managed super fund and an industry fund is that in a self-managed super fund, in the same $1 million pot, you actually could have set up 2 or 3 or 4 different pensions.
Yes.
And so if you've done that, i.e. I retired and I put $1 million in a pension phase and that's all taxable. I take 120,000 out, I put that back into the same pot. If it's an SMSF, you can start a new pension with the 120 and quarantine that one tax-free.
Yeah.
Then the next year you do the same, or you do 360, you can quarantine that. So,
yeah, but we're not saying everyone needs a self-managed super fund.
No, it's a long way to shortcut.
Yeah.
If you've got one, that is a benefit of doing so, but the cost wouldn't weigh up the benefit of just doing that. But again, it comes down to, I suppose, the size or the funds. As mentioned, there's certain rules, there's limits. The limits do change, and so they have gone up. They could go down. There are different types, as mentioned. If you put it back in as a taxable component, then if you want to claim it back on tax, that's going to stay in the taxable portion. You can mix it up if you weren't intending to do so. Downsizer contributions are tax-free, which is good. So I've got a strategy we're doing now that we're going to double dip and do a downsizer and a recontribution.
Ooh, I like when you talk dirty to me.
To double dip. Even though it's not really new money going in, we're actually going to take taxable portions out to put back in as a downsizer. So in this case, there's 630,000 that we can change from taxable to tax-free within a couple of weeks with an SMSF, which is beneficial.
That whole downsizer and retirement, those kind of 5 years either side, you can really get cute with some cool strategies.
Particularly if you've got different age brackets. Again, another, I suppose, mishap or mistake, Michelle, if you have a high balance, can everyone put 360,000 in? No. If your total super balance is too high, but 1.7, 1.8 million, you're not allowed to put the whole 360,000 in. So if you took 360 out and a week later put 360 back in, because of your eligibility under the total super balance rules, and I won't get any more boring than that, you wouldn't be able to. So you would have breached that cap. They're going to refund you the money. You might not be able to get it back in. Then you're paying tax on that outside of super, blah, blah, blah. Proceed with caution.
So just on that, when I said you can get cute with strategies, can you correct my memory? If I downsized, had $1 million property, downsized, bought a new property, and there was 2 people, both over 55, both had lived in the house for over 10 years, sold $1 million property, then repurchased the downsize that was $900,000, and we'll excuse stamp duty and all that crap. We've got $100,000 extra, but if we had a pile of $500,000 cash over here, we've still ticked the box for downsizer, and we can actually get that $500,000 worth of cash into super, the $100,000 there from downsizer, which ordinarily you could have got in anyway. But fast forward, what if you had an asset from an investment property sale that was $600,000, and then you had another $500,000 cash? You could get all that money into super within that 90-day window of the downsize trigger.
Yeah, and it goes in as a tax-free component, so it's tax-free for your kids. So yes,
But I don't want to. I want to be very clear with this is not getting investment property proceeds into super via the downsizer, because you can't. But this is, we had money from the profits of an investment property in cash. We did downsize. After downsizing, there's a 90-day window to get $300,000 each into our super funds. We can just put that money that we've got in. It's after the fact that it was from an investment property.
Yep, exactly. So that strategy I was talking about before, they're upsizing. They're buying from $1 million to 1.4.
But it's just that trigger. We're over 55. We lived in the house for 10 years. It triggers the 90-day window.
Yeah, it doesn't. The buying has actually nothing to do with the downsizing.
Yeah.
You actually don't even have to rebuy.
No, it's just the trigger of sale.
The sale. So the house they're selling, exactly, they're over 55, they've been there for 10 plus years, they've got a 90-day window to put $600,000 in. Even though they're going to need all that money to buy a new house, they've got that window there. So they could just ignore it and go, well, that doesn't apply to us. We don't have extra cash hanging around. But either A, they might from an inheritance, they might from a windfall, they might from selling an investment property, or they might because they take a whole bunch of taxable component out that frees up that money to then recontribute as the downsizer and eliminate that tax on their beneficiaries pretty quick.
And that's it. If, all these facts and puzzle pieces, if you have the confidence to do this by yourself, knock yourself out. And that's exactly why I told my parents, I know enough of this stuff. I'm not doing it for you. You can pay Martin. You can pay an advisor, because I know if I slip up because I'm not across one detail or one procedural issue, it went in on day 92, not day 90. Screwed. Royally effed.
Every fund's different, but the BPay details or the bank details of a downsizer is usually different to a non-concessional.
Yeah.
So back to that other kind of mishap before you mentioned on the Facebook group, that also might be defence from the super fund going, well, you put it into this, you fill it in the form, we gave you the special detail. The most downsizer contribution details are not on your member portal. You have to request them and they go in separately. So if you put it in as a normal non-concessional, you probably can't reclassify it. So,
but I'm sorry, if you do sell an investment property, right, and I'll go out on a limb, most properties that people will sell might be $500,000, might be $800,000. You've got no problem paying $13,000 for an agent commission to sell the property.
Yeah.
No problem. Why wouldn't you spend a few grand and get strategic advice to make sure you don't F this thing up? I can't answer that, but that's kind of...
And many people do. And lots of people we work with, lots of advisors that people reach out to Retire Right Group. But I suppose we're emphasising there that there's lots of value in this.
Yeah. And I'm strategically, on purpose, we've now recorded 3 episodes in a row today. I'm strategically getting our listeners comfortable psychologically and all that, that to get good financial advice, you will have to pay probably at least $5,500. Probably.
Yep.
You might get 3.8, you might get 4.4 here and there, but I just need people to be aware that the spend for once-off financial advice, you don't need the ongoing, $5 or $6 grand divided by $800,000, probably going to be well under 1%. So can you sacrifice, if that money went to cash for a year, earn 4.5%, do you want to just sacrifice the first year at 0.5%? I don't know. Do you? I don't care. Just, it's so heartbreaking when you see posts in the Facebook group where people get the information, don't want to spend the money. They've got the money.
They get it 90% right.
They get it 90%, but they fall over. And do 10%. I sound pro-financial advice? Yes. Am I? Yes.
Yeah. And the only thing I think to add to that is that, like you mentioned on a previous recording, is the supply and demand ratio is such as that anyone who reaches out to the Retire Right website, if you speak with a financial advisor and they say our minimum fees are $5,500 or $7,000 or whatever they are, if they see that there's not value to be added in your situation,
They won't sell it to you.
they will. Our business, anyone who would reach out to through the Facebook group or the website will say that, hey, because of your circumstances, you're actually you're on the right path. You're not making any
Call
silly
your super
mistakes.
fund, they'll be able to help with you.
Yeah, maybe there's $1,000 to save there. It's not worth paying me $6,000 to save you $1,000. Just keep doing what you're doing.
And I think that's the good thing to call out. Like anyone that's on my trusted panel, I've got a handful of firms, yours is one of them. They will not sell your plan if you don't need it. Simple as that.
Yeah, in the nicest way. Most of the advisors on that panel are great advisors, and they're not desperate for. I need to earn $1 tomorrow. The businesses that have been around for a long time and will be around for a long time, and will go, there's value to add here, or there's not value to add here, and if there's not value to add, still have a phone call, an email exchange, check out this podcast, look at that video. That's all you need. Come back to me when A or B or C happens.
Yeah. Or you've got your super fund there, I'm just having a look at the schedule. Full disclosure, I think next week when you listen to this podcast, there's an episode sponsored by Aware Super. They're coming on to talk. It was a really cool chat, actually. They might just say, well, you got, good balance with Aware Super. Call them, get advice. They'll provide it as being a member. Like, it's all good. If they need to do more than some limited scope to the fund, they'll quote your fee. But I just want you to understand advice is worth it, and anyone that I recommend you to will not sell you a plan if you don't need it.
Agreed.
And you don't have to have ongoing advice. Simple as that. You'll benefit from it. All right, Martin, it's been real. It's been good. See you.
Thank you, sir.
See you next week.
Let's do it.
Hey, if you found this useful, please send it to a friend or family member. And one thing that really helps us get the word out there is if you're on Spotify or Apple and you genuinely have learned something, can you leave us a little 5-star comment? That would be so amazing.
It helps.
Thanks, friends. Bye. Thanks for listening to today's podcast. If you want to support us, there is one way you can do that. You can send the episode to a friend, a family member, or your group chat if you think those people would find it valuable. We also thank you for leaving a review on Apple or Spotify. If you've listened to this podcast for some time, or if you've read any of my books, you would know that giving and generosity in a financial sense is a big thing in my life. If you think it's time that you are ready to give financially to a good cause, you could head to our website, moneypodcast.com.au/charities to see the charities that we support.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, trading as Retire Right Australia, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds Financial Service Licence 451289. Martin McGrath, Financial Edge Group, and their employed financial advisors are authorised representatives of Synchron Advice AFSL 243313. Opinions or comments from any guests on the podcast are theirs and not those of the hosts or the publisher or their respective licence holders.